Shares of Confluent are absolutely crashing. I'm recording this on November 2nd, just after the market has opened, and the stock is down 43. Is the company in substantial trouble, and should investors stay away from this company? I'm Jason Hall. This is The Smattering, and we're going to take a closer look at Confluent. I'm going to tell you right now, I don't think investors should be staying away. This could be an opportunity to buy. But before we get to that, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check that link out after this video. Okay, let's take a look at Confluent stock. Again, down 40% just today. It has been absolutely brutal. And for the year, that has essentially wiped out all of its gains and more. Before today, the stock was up 30% for the year, even after giving up some gains like a lot of tech stocks from the highs over the summer. But now we've gone from a winner to a loser. What is going on? Did the company just announce that it's lost half its customers and things are in trouble and it's going to have to raise capital because it has no money? That's the funny thing about it. We're going to take a look at the company's earnings report, and we're going to highlight some things that management had to say to us. So let's start with the numbers. Revenue was up 32% year over year in the quarter, reached $200 million. Cloud, this is important. This is a key part of the business. A big part of its strategy is cloud services built on Apache Kafka, which we'll talk about a little bit. It's the open source platform the founders of this company created, that they've built their business on top of. Again, this continues to grow at a much faster rate than total revenue, and it's gradually becoming a bigger and bigger part of the company's mix, which is good because it's more profitable and it's where there's more demand. Operating margin on a non-GAAP basis increased. Profitability is starting to get better. Their adjusted earnings per share, they said they earned about 2 cents a share on an adjusted basis. Now, there's some pretty big adjustments that you have to factor in. Okay, so you look at these numbers like, all right, this doesn't look so bad. Why does the stock look like it's going to lose almost half of its value in a single day? It's always the forward guidance. The market always looks ahead. They've backed down on their guidance for the fourth quarter. Now they're saying revenue is going to grow 21 to 22%. And that cloud business is going to grow 43%. Again, 2% revenue growth and 61% respectively. Now they're saying low 20s, low 40s. These were both already slowing growth from the companies over the past couple of years. Yeah, so then they highlighted a couple of specific things. One, macro pressure. The Middle East, needless to say, terrible what's happening there. And Israel is a big market for Confluent. Not minimizing the loss of life and the tragedy that's happening there, but from a business perspective, it's a top 10 market, and that is affecting Confluent. So rightfully, they're adjusting their outlook based on those changing business conditions. And then, of course, here on the left, this is the bigger deal. A couple of large customers, one which it looks like moved away from the cloud back to their own data center. So now Confluent didn't make it clear in their presentation whether that customer is no longer using Confluent or they simply moved away from Confluent Cloud. That wasn't as clear, but we had that one customer that made that move. And then it has another large customer that is being acquired that is slowing its ramp of taking on more and more Confluent Cloud. So there's a lot of uncertainty there that's driving the market's negative reaction to sending the stock sharply lower. Now, I think investors need to take a more measured approach. So what I think we should do next is take a few minutes. Let's go through the rest of the earnings presentation, look for yellow flags, look for signs of weakness, but also look for some indications that the thesis for the company is playing out, or if there are actual real problems that are material and persistent that are undermining that thesis. So let's hop back in the presentation here. Here is a particular slide that does give us a little more line of sight into what's going on. Again, Confluent Cloud revenue, that all important and increasingly important part of the business. It's now a little bit less than half of revenue. The goal is for this to continue to grow to become the majority of revenue for the business. And they give us a little more clarity on exactly what happened. So they said notable impact in the last few weeks of the quarter, talking about those two large customers. And then they further highlighted that they expect a greater impact through the fourth quarter and into next year. So what they're telling us is this isn't just a one quarter thing, that they're expecting this to continue to weigh on results going forward. Now, Confluent is still a young company, a small company. We're talking about a couple $100 million a quarter in revenue. It's less than $1 billion in annual sales business. It's still a relatively small business when we think about these massive cloud services businesses, and the opportunity is very large. One of the things that happens with these businesses is you might end up with a couple of really large customers that make up an outsized share of your revenue. And when things don't go perfectly with that customer, it can upend the apple cart a little bit. And I think that's what we're seeing here with Confluent is exposure to a couple of large customers that have made a change in their plans with Confluent Cloud. It's affecting the business a little bit. And we see that playing out in real time in the stock market with how investors are reacting. Now, I think there's a couple things that I do want to focus on the positive side that I think are really important. Number one, we continue to see gross margin trend in the right direction. Total gross margin, 76.4%. That's a big increase, 540 basis points. So it went from the low 70s to the mid to high 70s. And then subscription gross margin reached 80%. That is wonderful. That's better than Microsoft level gross margins. And that's going to produce those margin dollars that can help fund the business, assuming it can keep its operating costs in line. Here are some other key metrics that I think are really important to looking at the bottom line. Because again, the key with this company went public, raised a bunch of money, sitting on like $1.5 billion. It's burning that money, but it's doing it with intent to try to add scale, to attract more of those large customers. So what are we seeing? Operating margin was negative. We know that because it lost money on a GAAP basis, 22 basis point improvement year over year. Again, that's still on an adjusted basis. Free cash flow margin, I think this is interesting to look at, negative 6.5%. So it's still burning cash too, but all of these things are starting to trend better. Now, we'll take a look later at the balance sheet and the operating statement, and we'll highlight a couple of key things that stand out to really show the trends when it comes to its finances. And I think they're generally positive. So here's a key thing, though. This number is right here, $1.9 billion in cash and equivalents and short-term investments, and things like treasuries that can be quickly turned into cash. Plenty of money on the balance sheet. Once we get into the operating statement and the balance sheet, you'll see plenty of money to continue to fund the business. All right, before we get into that, though, again, let's talk about where things are going with the business. We talked about that revenue growth was up over 30%. Total customers increased 16%. So what does that mean? That means that it continues to get a higher spend from customers. This is even with a couple large customers, one kind of backing away a little bit from cloud and the other one slowing its growth as it's being acquired. Once it's acquired, it's who knows what's going to happen. But again, the key is that customers are spending more money too. That's a great trend, I think, for the long term. It's one thing to land the customer. It's another thing to expand the customer. And Confluent consistently is doing that. Another thing is big customers that spend more than $100,000 in recurring revenue a year, up 25% year over year, not growing as fast as revenue, but it's growing faster than the customer count. So that's a positive thing that we're seeing. This is a really nice one. The big spenders, $1 million in ARR, 38% increase year over year, 155. That's a great sign that companies are really interested in the value prop that Confluent brings and that they deliver on it. I think that's really important. This is a great number that talks, again, about the land and expand model that we talked about a little bit here. And that's dollar-based net retention rate. This is like the comps for software as a service companies. You want to see that number above 100% because that means you're retaining and growing. And again, comfortably above 130% for cloud and for hybrid. Okay, let's talk a little bit about the guidance again. We already knew from those slides earlier that there was an expectation that we're going to see a slowing of growth in cloud. We knew that. Here's continued trends in the right direction. That operating margin, we saw it. That operating margin number, we continue to see it improve, getting close, again, on a non-GAAP basis, getting close to break even on an operating perspective. That's a real positive. Continues to get closer and closer to where we want it to be on a profitability basis. Now, let's talk about the big one, 2024. Looking at about 22% revenue growth. It's a lot like what they're forecasting for the fourth quarter, but it's a lot lower than what we have seen from the company so far this year. 31% revenue growth year over year. That's a 50% slowing of revenue growth. That's a big step backwards in the eyes of Wall Street. But again, Management's being upfront with us. I really appreciate that. I think as investors, we should appreciate that they're not slow walking this or they're not trying to sandbag. They're telling us upfront, this could be a real issue. So we see the guidance, we see the trends and the improvement. We know this company is still losing money. They're still burning cash. Let's take a look at the balance sheet. How are they going to continue to fund the business if they're losing money and if growth is slowing? How worried should investors be? And I'm going to tell you, I don't think investors should really be all that concerned. If we look at current assets, this is basically, so you have cash, marketable securities. This is probably mostly short-term treasuries. And then you have other things like accounts receivable, customers that owe you money, things that can be quickly turned into cash, almost $2.2 billion. So that's essentially the same as it was at the beginning of the year. So that tells you there's plenty of liquidity to work with. Now let's look at debt, convertible notes. There's just under $1.1 billion in convertible notes. The interest charge on those is effectively zero. This is a company that is in very strong financial shape with its ability to continue to fund its operations. On a cash basis, I think it burned about $15 million last quarter. So it has substantial financial resources. This is exactly the sort of business that should be aggressively spending money on customer acquisition to grow its customer base, expand those customers, continue to expand its margins. And just like we saw with CrowdStrike, I'm going to put that name out there as a company that, again, different industry. Cybersecurity is very different than data streaming, but very large markets, very important markets. Similarity in business model. You spend money to aggressively grow, attract customers, retain those customers, expand your relationship with those customers, go from losing money, burning cash, to cash cow relatively quickly. I think that's the way things could play out with Confluent. So I want to tell investors, again, this is not a risk-free investment. There's the risk of disruption. We're seeing that growth is certainly slowing, and it's slowing a lot. But I think the market could be giving investors a wonderful opportunity and a great risk-adjusted reward opportunity with Confluent. I intend to add to my position. I think this is a great time to be buying shares of Confluent.